The number on the screen right now is not a glitch. It is not a data error. It is not a misprint from some obscure overnight trading desk. Shanghai is paying $100 for silver. New York just rejected $90. Let that sit for a moment. The same metal, the same ounces, the same atom, two prices, two markets, a $13 gap that cannot exist in a functioning global commodity system. And yet, here we are. My name is John, and this is the Asian Guy TAG. What you're about to hear is not opinion. It is not forecast. It is the raw data read line by line from the physical silver market, the version that does not get sanitized before it reaches your screen. Let us start with what happened in the Western market, because context is everything here. On February 9th, 2026, silver was trading in the mid-$30 range at spot. COMEX registered silver, the only category of metal that can legally be tendered against a futures delivery obligation, stood at 276,630 ounces. That number felt tight already. Analysts who track the registered to open interest ratio were already flagging structural stress. What happened next was not predicted by any mainstream financial desk. By late February, silver accelerated toward $96, $40. Momentum was building across both retail and institutional channels. The January 2026 delivery cycle had already printed the highest physical delivery demand in modern COMEX history, with approximately 62% of contracts entering the delivery window ultimately demanding physical metal instead of rolling or cash settling. That number was not normal. In a typical COMEX delivery cycle, the physical delivery rate runs between 5% and 15%. January ran at 62%. The physical market was already screaming. The lease rate, the rate at which silver can be borrowed and lent in the institutional market, had climbed to approximately 3% on the 1-month tenor. The 5-year average for that same rate from 2019 through 2024 was negative 0.09%. The current rate, as of early March 2026, is more than 30 times that average in the positive direction. That is not noise. That is a market structure that has inverted completely. Then came February 28th. Silver peaked at approximately $96.40, and then the paper market broke. Margin calls hit leveraged long positions at every technical level on the way down. The 200-period moving average at 87.69 offered brief support and then gave way. By Wednesday, March 4th, silver had crashed to a low near $78 before recovering to 85.64. JM Bullion's ask was $86.77 that same session. The Dow dropped sharply in the same session. The dollar surged to a 6-week high. The ISM prices paid index printed at 70.5, the highest reading since June 2022. Inflation fears killed rate cut expectations in a single afternoon. Margin calls liquidated leveraged silver positions at every technical level down to the 200-period moving average, and then below it. That crash happened. It is in the tape. It is documented. Now here is what the crash did not do. It did not produce a single additional ounce of registered silver. COMEX registered inventory, which stood at 102,256,630 ounces on February 9th, had fallen to 87,985,190 ounces by March 3rd. That is 14 to 271,000 ounces drained from the registered category in 22 trading days. Nearly 650,000 ounces per day, leaving the only silver on COMEX that can legally be tendered against a futures delivery obligation. The price fell 19% from peak to trough. The registered inventory kept falling. Physical buyers did not back away from the market. They accelerated into it. By March 3rd, the combined total of COMEX registered plus eligible silver, the full vault inventory, stood at 173,810 ounces. In October 2025, that same combined figure was 532 million ounces. That is a 33% decline in 5 months. This metal is not being reclassified. It is not moving between accounting categories. It is leaving. The vaults are physically emptier than they were. Meanwhile, COMEX delivered over 52 million ounces in March alone, representing 10,526 contracts that stood for delivery on first notice day, February 27th. By March 3rd, 5,694 of those contracts had been delivered. 607 additional contracts were delivered on March 3rd alone. The delivery pace is running at multiples of anything ever recorded in modern COMEX history. Now look at the number that sits at the center of this entire story. The May 2026 silver futures contract carries 274 contracts of open interest as of March 3rd. That represents 401,400,000 ounces of paper silver. May 1st notice day falls on April 30th, 2026. That is 57 days from now as of this recording. 401 million ounces of May open interest, 88 million ounces of registered silver available for delivery. If you are a paper contract holder and you decide to stand for physical delivery, the exchange needs registered metal. Right now, registered metal covers 22% of the May open interest. That is the starting condition, not a forecast, not a worst case. The actual ratio on March 3rd, 2026. The bounce from $78 to $85 happened because buyers who understand these numbers treated the crash as a discount event, not a warning signal. Shanghai never stopped paying $103. That premium did not shrink during the COMEX crash. It widened. And that tells you something that no price chart will show you directly. Let us now talk about China. Because China is not a footnote in this story, China is the other half of it. James Henry Anderson, who tracks global silver inventory flows professionally, posted on March 4th that combined SHFE and SGE silver vault stocks have fallen to 752 tons, equivalent to 24,200,000 ounces. He described this as the lowest level in a decade. His conclusion was direct and without ambiguity. Either silver trades much higher to bring in new inventory, or Chinese authorities are going to have to halt silver withdrawals soon. Those two sentences describe the entire structure of the problem. Physical silver does not grow on trees. At some price, holders of physical silver will decide that selling into the market produces more value than holding the metal. That is the mechanism that eventually resolves any commodity shortage. The question is at what price that equilibrium reasserts itself. If Chinese vault stocks are at 24 million ounces against a Chinese solar, electric vehicle, and electronics industrial complex that consumes silver at approximately 230 million ounces per year, the stock-to-flow ratio is roughly 5 weeks of industrial consumption. That is not a buffer. That is the absence of a buffer. A single supply disruption, a single logistics bottleneck, a single policy intervention, and that 5-week cover disappears. Bloomberg confirmed in November 2025 that Chinese silver stocks at the SHFE hit a 10-year low. ING analysis from the same period documented SHFE stocks at their lowest since 2015. What Anderson is reporting in early March 2026 is that the drawdown which Bloomberg and ING flagged in late 2025 has continued and accelerated. The 17% premium that Shanghai silver was trading at over Western spot prices in early March confirms exactly what the vault data shows. When the same physical commodity trades at materially different prices in two connected markets, it means the arbitrage mechanism has broken down. Moving metal from New York to Shanghai to close the premium is economically rational but logistically constrained. Here is why that constraint has deepened. Chinese export controls on silver implemented in January 2026 affected 44 major firms and made the reverse flow structurally more difficult. In January 2026, China implemented a silver export licensing regime, requiring all exporters to hold at least 80 tons of annual production capacity. That immediately excluded the majority of smaller silver producers and traders from the export market. On January 26th, the SHFE slashed daily silver position opening limits from 3,000 to 800 lots per session, a 73% cut in a single regulatory action. Multiple Chinese silver and gold funds suspended new subscriptions starting January 28th. These are not market corrections. They are policy interventions by a government that has decided to treat silver as a strategic material and is building domestic inventory by restricting outflows. China currently holds roughly 17% of total global silver mine production within its borders. China exports between 4,000 and 5,000 tons of silver annually. Restricting those exports does not just affect China. It removes a significant source of global supply that Western industrial consumers, ETF custodians, and COMEX vault operators have relied upon for years. Now, let us look at what the ETF complex is telling us, because this data point is one that most retail investors completely miss. Since February 9th, retail investors sold approximately 15 million ounces of physical silver through ETF redemptions. SLV holdings fell from approximately 842 million ounces in early February to a trough near 827 million ounces. The total silver ETF complex, which JM Bullion and Harris track, fell from approximately 870 million ounces at the December 2025 peak to approximately 828 million at the trough, a 42 million ounce reduction. Here is what that 42 million ounce reduction did to the physical market. Nothing. The lease rate did not normalize. The swap rate did not revert to positive. The backwardation did not flip to contango. COMEX registered inventory continued falling, despite the ETF outflows adding supply to the market. Let that register. 42 million ounces of ETF selling entered the physical market and could not normalize the lease rate, could not rebuild registered inventory, and could not push the forward curve back into contango. If 42 million ounces of ETF selling cannot normalize the physical market, what does a return of that same buying achieve? Anderson's calculation is direct. Retail buying back 15 million ounces through SLV tightens the market instantly. because every share of SLV created requires physical silver to be deposited with a trust custodian. Authorized participants cannot manufacture SLV shares without sourcing and delivering physical silver. That silver has to come from somewhere. Right now, somewhere is already almost empty. SLV reported 30-day net inflows of $1.75 billion as of March 3rd. The bounce is already starting. The retail bid is returning after the crash because buyers who understand the fundamentals are treating the $78 print as a gift rather than a warning. SLV is currently trading at a negative 4.86% discount to net asset value. In a normal liquid market, SLV trades extremely close to its NAV because authorized participants continuously arbitrage any gap. When SLV trades at a near 5% discount, it means either the authorized participants cannot source physical silver quickly enough to create new shares and close the gap, or the risk of sourcing physical silver in size has become too expensive to be worth closing. Both explanations are structurally bearish for the paper price in the short term and structurally bullish for physical silver. Now, let us read the swap rate, because this number is the one that separates analysts who understand the physical market from those who do not. The 1-year silver swap rate on March 3rd was negative 2.973%. In a commodity market with normal supply and demand, the forward price of a commodity is determined by the spot price plus the cost of carry. Cost of carry for silver includes the risk-free rate, currently around 4.25%, plus storage costs of approximately 0.27% per year, minus lease rates. In a balanced market where silver can be borrowed and lent freely at minimal cost, the 1-year forward should be approximately 4 to 5% above spot. The swap rate, which measures the carry-adjusted basis, should be close to zero or slightly positive. The current 1-year swap rate is negative 2.973%. Adjusted for the risk-free rate of 4.25%, the total deviation from fair value is approximately 7.2%. This means the market is pricing physical silver for delivery 1 year forward at roughly 7% below where financial mathematics says it should trade. Physical silver in 12 months is cheaper in forward markets than it should be given the cost of money and storage. Why would anyone price silver this way? Because the market is paying a forward discount to lock in physical delivery at a known price rather than face the risk of not being able to source physical metal in 12 months at any price. The negative swap rate is the market explicitly pricing physical scarcity risk. It is not a rounding error. It is not a technical artifact. It is the most direct financial measure of how tight the physical silver market actually is. Analyst Carol Merks, who has tracked this metric throughout the bull market, posted that the 1-month silver lease rate of approximately 3% is by itself sufficient to signal a new all-time high is only a matter of time. The 5-year average lease rate from 2019 through 2024 was negative 0.09%. The current rate is more than 30 times that average in the positive direction. For the lease rate to normalize at current gold prices, and with silver where it is, several things would need to happen simultaneously. COMEX registered inventory would need to rebuild substantially. The May delivery pressure would need to dissipate with outstanding demands walking away from the market. Chinese vaults would need to restock, and ETF outflows would need to resume. None of those are happening. The lease rate will remain elevated as long as the physical market remains tight. Now look at the backwardation data, because this is where the forward curve tells you something that spot price alone cannot. The entire forward curve for silver is inverted. May futures are trading at $83.47. July futures are at $84.80. The July minus May spread is negative 60 cents when adjusted for carry. The carry-adjusted basis column shows 0.54, meaning the market is trading 67 cents below where it should be in fair value terms, given the cost of carry. The backwardation contango column shows 0.067, highlighted in red, meaning the market is in backwardation. In a commodity with no supply concerns, the forward curve slopes upward. Sellers of forward contracts demand a premium above spot to compensate for the cost of storing the metal until delivery. When the forward curve inverts and forward months trade below spot, it signals that market participants urgently need physical metal now and are willing to pay a premium for immediate delivery over deferred delivery. The steeper the backwardation, the more urgent the physical need. Silver has been in backwardation for months. The backwardation deepened through the delivery crisis. It has not healed through the price crash. When prices fell from $96 to $78, the backwardation remained. Physical buyers did not back away from the market. The backwardation stayed red because the price crash did not produce additional physical silver. There is no switch that creates new registered ounces when prices fall. Now let us put the complete picture together because the individual data points only tell part of the story. On February 9th, the spreadsheet starting date, registered silver was 102 million ounces. The implied deficit column showed 263 million ounces against March open interest of 365 million ounces. The days to clear deficit was 17.9 days, meaning at the existing daily open interest reduction pace, the deficit between paper claims and physical reality would take 18 days to reduce to zero. The deficit clears by date was March 5th. March passed. The May contract now carries the torch for 1 million ounces of May open interest, 88 million ounces of registered silver. The implied deficit for May is 313 million ounces. At the current daily open interest reduction pace, the days to clear that deficit extends well beyond the April 30th first notice day. Run the scenario math carefully because every percentage point of delivery demand matters at this inventory level. If 10% of May contracts stand for delivery, that is 8,027 contracts, representing 100,000 ounces. That is 46% of registered inventory claimed in a single delivery cycle. If 15% stand, that is 12,041 contracts, 200,000 ounces, 68% of registered inventory. If 20% stand, that is 16,055 contracts, 275,000 ounces, 91% of registered inventory. If 25% stand for delivery, 100% of registered inventory is claimed with contracts still remaining unfulfilled. These are not exotic tail scenarios. The January delivery cycle saw rates approaching 62%. Even a historically moderate delivery intensity in May would push COMEX to a position where the exchange must either source metal from eligible conversion, suspend deliveries, or pay extraordinary cash premiums to induce delivery waivers. All three of those outcomes are unprecedented in the modern era. All three would produce a price response that cannot be modeled from recent price history. Now consider what is building on the demand side while this supply picture deteriorates. The solar industry alone consumed approximately 232 million ounces of silver in 2025, according to the Silver Institute's preliminary estimates. Electric vehicle production, which uses between 25 and 50 grams of silver per vehicle depending on the architecture, is scaling at a pace that adds millions of additional ounces of annual demand every quarter. The defense sector, and this is a number that almost no retail analyst tracks carefully, consumes silver in missile guidance systems, radar components, and electronic warfare hardware at volumes that have increased sharply since 2022. The United States military budget for fiscal year 2026 includes procurement line items that embed silver consumption across dozens of weapons platforms. The F-35 program alone uses approximately 1 troy ounce of silver per airframe in various electronic components. At current and planned production rates, that is a non-trivial industrial demand source that does not respond to price. Defense procurement officers do not check the spot price before ordering silver-bearing components for a $100 million aircraft. Industrial demand for silver is not discretionary. It is not elastic in the short term. A solar panel manufacturer who is contracted to deliver 500 megawatts of panels by a certain date cannot substitute aluminum for silver in the bus bars. A defense contractor producing radar systems cannot swap in a cheaper metal for silver-brazed waveguide components. The demand is structural. The supply is constrained. And the inventory sitting between those two realities is 88 million ounces of registered COMEX silver, against 401 million ounces of paper claims, against Chinese vaults at a 10-year low, against ETF buying that is already returning after the crash, against a lease rate 30 times its historical average, against a forward curve that is inverted across every delivery month. The market is not predicting a shortage. The market is already pricing one. So let us now talk about the number that nobody in mainstream financial media is willing to say out loud. Where does silver go from here? Not as a prediction, not as a forecast, with a disclaimer attached, as a structured reading of the data that is already published, already verified, and already sitting in the spreadsheets that almost nobody reads carefully enough. Start with the gold to silver ratio, because this is the instrument that tells you how mispriced silver is relative to the metal that the institutional world uses as its primary monetary anchor. As of early March 2026, gold is trading at approximately $2,900 per ounce. Silver recovered to approximately $85 after the crash. The gold to silver ratio at those levels is approximately 34 to 1. Historically, the ratio has averaged between 50 and 60 to 1 over the past 4 decades. During periods of acute physical stress in the silver market, the ratio has compressed toward 30 to 1 and below. During the 1980 Hunt Brothers episode, the ratio briefly touched 17 to 1. During the April 2011 peak, it compressed to approximately 32 to 1. A ratio of 34 to 1 tells you that silver is already outperforming gold on a relative basis. It does not tell you that silver is done outperforming. Every data point reviewed in this analysis points toward further compression, not reversal. If the gold to silver ratio compresses to 25 to 1 with gold at $2,900, silver prices at 116. If gold moves to $3,200 and the ratio compresses to 20 to 1, silver prices at $160. These are not fantasy numbers constructed from enthusiasm. They are ratio arithmetic applied to a market structure that is already in documented physical stress. Now let us talk about what the resolution of this stress actually looks like in practice, because understanding the mechanism is more important than knowing the destination price. There are exactly 3 ways a physical commodity shortage resolves: demand destruction, supply increase, or price rationing. Demand destruction in silver's industrial complex is not happening. Solar deployment targets set by governments across the United States, Europe, China, and India are not being revised downward. Electric vehicle production schedules are not being cut. Defense procurement budgets are expanding, not contracting. The industrial consumers of silver are not going to voluntarily reduce consumption because the spot price is elevated. They will absorb higher input costs and pass them through to their customers before they will halt production lines. Supply increase takes time. Primary silver mines require years of capital investment, permitting, and construction before the first ounce reaches a vault. Secondary silver recovery from recycling responds to price, but with a lag measured in months, not days. The 88 million ounces of COMEX registered silver that exists today is not going to be supplemented by a new mine that opens next quarter. There is no supply response that arrives in time to resolve the May 2026 delivery cycle. That leaves price rationing. The market raises the price until enough holders of physical silver decide that selling at the current price produces more value than continued ownership. At some price, institutional holders of eligible silver convert to registered status and offer metal for delivery. At some price, retail investors who accumulated physical silver at $20, $25, and $30 decide to monetize their positions. At some price, recyclers accelerate recovery operations. That price is not $85. The lease rate at 3% and the backwardation across the forward curve are telling you directly that $85 is not high enough to bring sufficient supply into the market. Now look at what is building in the options market, because derivatives positioning ahead of a delivery crisis is one of the cleanest forward indicators available. Call open interest on COMEX silver options at strikes between $90 and $150 has been building steadily through February and into March. Large institutional players do not pay option premiums for strikes that they believe are unreachable within the contract period. The positioning in the options market reflects a segment of institutional money that is explicitly planning for a price dislocation in the $100 to $150 range within the next 6 to 9 months. This is not retail speculation. Retail traders do not buy deep, out-of-the-money COMEX options in size. The open interest at those strikes reflects professional positioning by entities that have read the same vault data, the same lease rate data, and the same open interest figures reviewed in this analysis, and have made a capital allocation decision based on what those numbers imply. Here is the summary picture, stated as plainly as the data allows. COMEX registered silver has fallen from 102 million ounces to 88 million ounces in 22 trading days. May open interest stands at 401 million ounces against that 88 million ounce registered base. The lease rate is 30 times its 5-year historical average. The entire forward curve is in backwardation. Chinese vault stocks are at a 10-year low. China has restricted silver exports through licensing requirements that exclude the majority of smaller producers. The SHFE slashed position limits by 73% in a single session. ETF buying is returning after the crash, with SLV reporting $1.75 billion in 30-day net inflows. The SLV discount to NAV of nearly 5% signals that authorized participants cannot source physical silver quickly enough to arbitrage the gap. Shanghai silver is trading at $123, while New York struggles to hold $90. That $13 premium is not an anomaly. It is the price the physical market is paying for metal that the paper market has not yet acknowledged is scarce. Every single one of those data points is public. Every single one is updated daily. Every single one is sitting in spreadsheets and exchange reports that are accessible to anyone willing to read them carefully. The mainstream financial media is not reading them carefully. The analysts who appear on television to discuss silver are looking at the spot price chart and calling the crash a buying opportunity or a dead cat bounce, depending on which narrative their desk is running this week. They are not reading the registered inventory figures. They are not tracking the lease rate. They are not monitoring the SHFE vault levels. They are not calculating the implied deficit between May open interest and available registered silver. You are now reading them carefully. The $13 gap between Shanghai and New York is not a pricing error waiting to be corrected downward. It is a signal waiting to be confirmed upward. When the paper market finally prices what the physical market is already living, the move will not be gradual. It will not give the majority of observers time to position. It will be the kind of repricing that happens when a market acknowledges simultaneously what the data has been saying for months. The vaults are not filling. The lease rate is not falling. The backwardation is not healing. The May clock is ticking. Invest with logic, not hype. The Asian guy TAG out.